Hi, folks. Welcome to the Money Pit Group. Robert Quigley, Washington, D.C. If you haven't subscribed to the channel, please push your subscribe button, add your comments and suggestions and criticisms below. Let's get started. Remember, we are on the road to the White House, and as part of our journey today, we're going to talk about prudent investment styles, specifically Warren Buffett's style of long-term investing. If you'll remember from previous videos, Warren Buffett made a comment last week that the U.S. stock markets, financial markets, have devolved into nothing more than a gaming parlor. And the short-term traders have just run amok and made a mess of tens of millions of portfolios, and essentially made it very, very hard for the investment side of the stock market to achieve its full potential. As we talked about before, if you want to gamble, you got better odds in Las Vegas. The stock market is there to fleece you. All right, so let's dig in specifically into Warren Buffett's style of investing. He filters his stocks. He's not looking for the gains of the day or the gains of this week or the gains of this month, but he starts off with a filtering process. And I'm going to outline just briefly the types of stocks that he filters for. And essentially what he's looking for, number one, cheap, safe stocks. And when we say cheap, safe stocks, we don't mean the penny stocks. We mean stocks that have a long, solid history and are cheap relative to their fair market value, which we'll talk about again in a few moments. The next variable in his screening process is he's looking for a low price to book value ratios. Okay, he's looking for stocks that have experienced above average volatility, and that's with past tense, experienced. He's also looking for profits that have been growing at an above average pace, and he's looking for stocks that pay out a portion of those profits in dividends. So essentially, he's looking for good, solid companies that are going to be around in 10 years, 15 years, 20 years, or more. And he's also looking for companies that he understands. He wants to understand the companies, and he wants to understand the market. We're talking about more than just a passive read the newspaper, listen to the news article, blib that says, gee, I understand that. No, he's looking for a real deep understanding of the company. So to give you an example, if a retail investor works for the company, or if they work in the industry, then that would give them the type of knowledge that we're talking about in terms of knowing the company that you're investing in. Now, on that note, I'll just add right here. I wonder if you guys know that 86% of all active fund managers over the last 10-year period have failed to beat the benchmarks, which basically means the market indices. That means if you were to just put your money in an S&P fund or a Dow fund, they would have outperformed 86% of the active fund managers. So if you are sitting on a mountain of cash, you might want to keep that fact in mind, because fees and set fees and performance fees and underperformance can really erode the value of money. But okay, going back to Warren Buffett's style of investing. With those criteria, we're going to build a position in a stock, and more likely than not, we're going to build that position over time. So we're going to have many entry points, many price points. If it truly is a undervalued stock according to one's view of fair market value, you're gonna average up or you're gonna average down as time goes by. That's okay, because if it's truly undervalued, then you're going to make a substantial move upward on that stock, and it might very well take years, and that's fine. I mean, Buffett tends to hold his stocks for life. I'm not sure that's the best way to do it. We'll talk a little bit about that later, but that's the process that he follows. All right, so what's the target exit on these types of investments? Well, it's fair market value. What does that mean? We've reached the top. It's all about the company fundamentals, financials, and future prospects. So very simply, if you take a graph, a very simple graph, on the horizontal line, you've got time. On the vertical axis, you've got price. You're going to have a curve going up from the left to the right. At some point, you're going to reach a price level where the line is going to plateau. It's going to even out. It's going to essentially go straight across the graph. And that's fair market value. And once we get to fair market value, well, what is that? Well, that means that the stock price is supposed to represent the value of all future cash flows discounted to the present. Now, if it's a great stock, it's going to have a premium added to that number. If it's a poor stock, it's going to be less than that number. So just to give some extreme examples here to show the point, Apple would be a stock with a big premium to that value of the future cash flows, and Kodak would be just the opposite. As we all know, Kodak used to employ 100,000 people. I think now it's got 3,000 or 4,000 people, a shadow of its current self. The old style photography is never coming back. And on the other side of the coin, the Apple iPhone is going to be making motion length movies before long. So everyone can be a Hollywood producer in the near days and weeks and years to come. All right, so that's fair market value. So if we put Warren Buffett's criteria into our screener, which, by the way, every stockbroker has a screener in their platform, so that's where you would do it. They're also available on the internet, so it's very easy to find these. So without talking individually about each one of the stocks, I did the screener and I came up with 15 of Buffett-type stocks. So I'll just give you the ticker and the name of the company, and then you can go off and do your own research and see if you can't spot some of the things I'm talking about. So the first ticker is AVD, and that's American Vanguard. The second one is CATO, which is Cato Corporation. The third one is CMCSA, which is Comcast Corp. The next one is EPC, which is Edgewell Personal Care. The next one is FCFS, which is First Cash Holding. The next one is HWKN, Hawkins. The next one is INTC, which is Intel. The next one is JNPR, which is Juniper Networks. The next one is MATW, which is Matthews International Corp. The next one is NWL, Newell Brands. The next one is RGP, Resources Connection. The next one is SPTN, Spartan Nash Company. The next one is TG, Tredegar Corporation. The next one is UGI Corp. And the last one is WBA, Walgreens Boots. So essentially, if we're using Buffett's style of investing, we're going to allocate our money across all or some of those stocks, or we're gonna take one or more of them and build a position in them over time. And essentially, what we're doing is we're looking for recent lows, recent pullbacks, and considering that we're just coming off of a virus, I would basically say that everything that happened in 20 and 21 is suspect. So if you were to bring up a price chart and you go back to 2019 and maybe take a 500-day moving average of what that stock price was, say up until at the very latest, let's just say it's March 1st of 2020, and if you were to figure out what that price is, that number would be an excellent long-term entry point for most of the stocks on the list, or as close as one could get to that would be your second choice. And then you got to figure out, based upon the fundamentals and financials, what the fair market value of that stock is going to be. And I wouldn't, I wouldn't use the rule of thumb that whatever the high was during the pandemic is the ultimate best exit area, because there's a very strong possibility here that the highs reached during the pandemic may not be reached again for 10 or 20 years. I mean, in fact, when you account for inflation, or when you adjust for inflation, purchasing power parity, and so forth, we may not see those highs for a very long time. But using this method of investing and what I've just described in terms of entry points, there's money to be made for stocks that are worth substantially less than their fair market value. There's a whole lot that can go into that. One could teach an entire course in finance just on that one topic, but for the course of a video that's going to last 30 minutes more or less, 20 minutes, that is a taste of the way to go on this issue. Okay. Let's look at some of the problems here, and let's look at some of the law reform. Because remember, we are on the road to the White House, and Wall Street is ripping a lot of people off, and we need to make some serious corrections. Subscribe to the channel, make your comments below, join the conversation. Tell me where I'm right, tell me where I'm wrong. I'd love to have a debate with anybody, anywhere, anytime about anything I say. If I've misspoken, correct me. If I haven't spoken enough, add some more. Problem number one, short-term traders. You're going to hear this a lot. Why are the short-term traders the enemy of the investor? An army of short-term traders owning a majority of the stock will keep the stock price from reaching its fair market value, because there are always too many sellers. Stock is in the hands of too many people who don't want to own it for the long term. They're looking for the quick buck, and all of that daily, hourly, minute, continuous selling pressure is going to keep a lid on that stock ever reaching fair market value. Versus stocks that are owned largely by people who do want to invest in the stock for the long term, institutional investors, long-term retail holders. There's less selling pressure. So, of course, by default, that stock price is going to be able to move up to fair market value sooner and stay at that level for a much longer period of time. So, that's the problem. That's the first problem we have. Remember, in this channel, we're going to, and on our road to the White House, we're going to do everything we can to reduce this world of short-term trading. Margin. Well, it's very simple. If you're in the world of short-term trading, margin is the wrong way to go. The risks are too high. Market gyrations happen every second of every minute of every day, and the chances of getting wiped out in that position or the account are very high. Whereas, if you're a long-term investor and you're using this Warren Buffett style of investing, and as long as one keeps a certain amount of cash in their portfolio for a gyration cushion, then by all means, margin would be a very safe way to go, especially if you got those lower entry points. Now, mind you, even in this perfect world, or in the best world of investing, rather, margin can still be dangerous because the economy can go nuts at any moment in time. So one always has to be prepared to add money to the account. But in terms of in comparing it to short-term trading, it's more or less a non-issue with these Warren Buffett style of stocks. Okay, let's go to the next topic here, and it's gonna highlight again this point between short-term trading and long-term trading and fair market value. Let's take two really famous stocks in the American market. Ford, which started in 1903 and currently trades for $14.45. Yesterday it was one of the stocks that made it to $15. Absolutely nothing in Ford's makeup accounts for that 50-cent change in price. It's just short-term trading. That's all that's going on. Short-term traders running around with their heads cut off, making a mess of the market. We take GE, for example. GE was started in 1892, and it is currently trading for $78.09. Same story as Ford. The basic idea is trees do not grow to the moon. And these stocks, being two of the oldest stocks in the U.S. market, you would think if it had long-term growth that these stocks would be two of the most expensive stocks in the market. Everybody knows Ford. It makes a huge number of cars. You know, 1,000 times more cars than Tesla makes. But its stock price is pennies as compared to Tesla. GE. GE at once upon a time had its finger in every industrial enterprise in the country, it seemed like. Uh, it should also have this massive stock price. But no, it hasn't, because over time, competition has come on board, and the market overall has taken a dimmer view of what these stocks are worth. Um, but the key point is the fair market value, and it has to be based on real, true economic fundamentals and accounting statements of the company and its prospects in the market. GE, it's a shadow of its former self. It doesn't make the same number of products. It doesn't have the same amount of profits. It's come down. It's actually at a recent high, but overall, comparing it to other companies in the industrial age, you would think it would be higher. So as time goes by, the fair market value is adjusted down, and the same with Ford. Um, it should be a much, much, much higher stock. I mean, we're talking, this several $100s, but it's not. And of course, there have been stock splits, and of course, the Ford management has taken the view that they wanted to have a wider shareholder ownership. Of course, Ford is owned by lots of institutions and hedge funds and mutual funds, and when they're more long-term holders, there's less price volatility. So all of those add together to make a lower price. But from a video's point of view, stocks don't grow to the moon forever. Okay, well, what's another problem in the stock world? Well, the media problem. This is huge. Again, this allows short-term traders, day traders, and scalpers to wreak havoc on the portfolios of investors. So be careful when we hear anybody in the media talk about stocks. Let's look at CNBC, for example. CNBC, from 5 or 6 o'clock in the morning when they start until 8 o'clock at night when they finish, they have a parade of people talking about stocks, the market, their portfolios, why things are good, why things are bad, where we're going, where we've been, where we're likely to end up. I mean, it just goes on and on and on and on. I mean, what I just described in that short paragraph is essentially what CNBC is doing. I mean, if you watch it enough times, you're going to get an absolute headache because, it's one talking head after another. But if we step back from this and we look at this, we say, you know what? These people are talking their book. And this is an inside secret. Anybody that gets on CNBC and other financial media for that matter, they're very likely to hold the positions that they are advocating on the air. And 99% of the time, they do not disclose it. There's a problem with that because what I've just described to you is essentially a pump and dump scheme. Or if they don't actually dump the stock at that time period, they are out there trying to support the stock. They're trying to push it up or down, as the case may be. I've got an iconic example coming up here in a second. But that's a problem. So when we're long-term investors and we've already done our research, you can basically turn off CNBC and not listen to any of them. If you're trying to get a feel for what's going on in the market, then we have to take every word they say with a very large dose of salt or sugar, depending on how you want to look at it, because it's a problem. So let's talk about some issues here. Jim Cramer, and I've done what I've said before many times. Jim Cramer's a famous guy in the investing world. He's a likable guy. The guy's neurotic. He can't stop talking. I mean, if I had to live with the guy, it would last about a day. He'd be gone because the guy just won't stop talking, and you can't get a moment's worth of peace when he's around. I mean, you can see this on the tube. The guy is a talker, okay, and he's constantly talking about stocks. Entertaining, yes, but he's a talker. But if you pull up your stock trading screen, and I do this on my Schwab platform, and I do this on my TD Ameritrade platform, this guy, if his mouth utters a stock ticker, I will put that stock ticker immediately into my trading screen. And I've got 16 monitors up here. I have got graphs. I've got different ways to slice and dice anything I put into my system. And lo and behold, every single time, if he is talking positively about that stock, there's a bump in the stock price. It goes up. You can buy in a few minutes after he's finished talking about it. You can sell, and that's true whether he's talking positively or negatively about the stock. And he will tell you that they are not able to own stocks. He's got a charitable fund that he owns stocks in, but there is a very long series of what I'm going to call pump and dumps going on. And this is actually the same throughout the day with most of the parade of speakers that come through CNBC. But I haven't tested very many of those, but I've just kind of noticed in passing. But the Jim Cramer example, I have tested many, many times, and as well as a couple of other regulars on the CNBC crowd, like the Nigerian brothers and their whole options world. So as a long-term investor, I would steer clear of these people, because essentially what's happening in the stock market is, on the short-term basis, crowds of people are being herded. This is called crowd herding. People are being herded to a particular stock, and that stock price is going to react in a negative or positive way. If you're already in that stock, you're going to be able to make a killing either way. And if you're subject to FOMO, which is the fear of missing out, or you're trying to capture these short-term profits, it's very easy to wind up on the wrong side of those trades. And essentially what we're talking about here is the media problem. We'll come to some reform in a minute, but just be aware that problem is there. How do you avoid this? Like I said, you do your own research. So let's talk about another example. Yesterday, Fed Chairman Powell came out and raised interest rates, Fed rates, by 0.5%. The market, he was asked some questions, and one of the questions by one of the CNBC talking heads basically said, is there going to be a 0.75% raise or a 1% raise? And Chairman Powell immediately said, no, it's only going to be a 0.5% raise. So with those words, the computer algorithms, which are slicing and dicing and parsing these words, probably went out and bought $100 million. I mean, they just went all in and bought the market. I don't know how much they bought, but it was a huge amount, because obviously in the next 1.5 hours, the market moved by 3%. The Dow was up about 950 points, and stocks across the board, all the indices stocks, almost everything went green. Wow, it's super. Okay, so now the bear market is over, and we're off to the races again, and everybody start buying stocks. Market closes, and then of course, guess what happens? The very next day, we turn on our computer screen after we've all climbed out of bed and had our coffee and got to the computer, and the market is headed down. And at this point in time, we're talking about more than a 3% decrease, about a minus 1,085 points more or less on the Dow. So yesterday, in the last hour and a half of trading, $1 trillion was added to the stock market value, and today we're not even at 1230, and more than $1 trillion has been taken off of stock market value. Now, this would be one thing if we were talking about a whole bunch of people out there trading, but this is algorithm trading, algos and computers gaming the system. Now, that $1 billion came from someplace. There would have been an awful lot of people trapped yesterday. A lot of retail traders, a lot of professional traders. It's what we call a bull trap. Get a stampede going, get a lot of people in the market, and reverse it. And remember the conversation about market makers. And if you haven't seen that video yet, it's titled "Scalping, Day Trading, Algos, and Law Reform." Go back and look at that. This is not a coincidence. Okay, this is crowd herding. This is moving the market, and the markets are not supposed to be moved like this by a small number of players. So seriously, if when I make it to the White House, the Secretary of the Securities and Exchange Commission and I are going to be having a very long lunch together, and we're going to set out an entire agenda to reform the market, because this is not the way. This is not smart investing, and it's really wreaking havoc on the portfolios of the real long-term true investors across the market. Okay, so law reform number one. Again, we're going to discourage scalpers and day traders. Any person that is going to speak on CNBC or in any public forum is going to have to simultaneously and fully disclose their positions, and it's as simple as that. Are they trying to ride those positions long? Are they trying to ride those positions short? There can be no shadow of a doubt where people stand on their portfolio and their positions in relation to what they're saying. Now, as it is right now, if you're smart about the media, you just totally discount everything. I mean, pretty much, the best thing you do is you just look for the bull or bear bias. I was talking about this in another video when we're trying to figure out which direction the market is going in. But in terms of the details, you got to discount it, because these people, they're on TV by default. They're unreliable. I mean, unless of course you're Chair Powell and you're an institution making the decision about the market. Well, obviously, those types of people you got to listen to, because their decisions what's going to happen. But what I'm talking about here are just participants of one variety or another. They need to disclose before they start mouthing off in the media. So let's talk about the biggest short bet in history. And this is a classic example of what I'm talking about. This occurred in March 2020 on CNBC. So March 2020, a gentleman by the name of Bill Ackman was a guest on CNBC, and he publicly advised the Trump administration to shut down the country. So let's just reinform ourselves right here. At that moment in time, the coronavirus was new. The Chinese had experienced it first. They closed down Wuhan. Lots of people wound up dead, and the world was kind of freaking out because memories of the plague and the 1918 Spanish flu and all sorts of other dreadful virus enemies came to mind, and people were very, very panicky, and with good reason. Essentially, as an analogy, we had the investing public sitting in a movie theater, and they could smell smoke. And what does Bill Ackman do? Bill Ackman comes in and essentially shouts, "There's a raging fire," and it's right outside the front door. So the back doors are like, very small, maybe one door, two doors, but you got 1,000 people in a theater, and everyone tries to head for the exit at the same time. So of course, what happens? Massive crash in the market. You can pull up the indices in the stocks. You'll see that massive spike down that I'm talking about. Well, he was coming across as sort of a very long-term, incredibly successful guy. He was a market pundit with a crystal ball, and he knew what was going to go on. But what we later find out is he had shorted everything in the market. Wow. He made the biggest bet in stock market history, and in those couple of days walked off with untold billions upon billions of dollars. I mean, we're talking billions and billions of dollars. I mean, it's a lot of money. And he did this because he scared the public into investing. I heard that interview. I was sitting right here at this desk. I was following the events of the day, involved in the stock market, involved in other desk type of activities. I heard every word of the interview. He did not disclose his short positions. He never detailed his short positions. He did not make a list of short positions. Yet he shorted everything, didn't disclose it, added fuel to the fire, took billions and billions of dollars out of investor pockets. I'm sure there were tons of people who sold out those days, took massive losses on their portfolios, and CNBC is responsible. Bill Ackman is responsible. Where is the SEC? Guy's never been arrested. He has never been charged with market manipulation. And to this day, as far as I know, he is sitting on this huge mountain of money. And it didn't come out of the air, it came out of other people's pockets. And if he would have said, before he was even at the very beginning of his conversation, if he would have disclosed his positions, and if he would have made it very clear what he was thinking was going to happen, and he had told the world what he was doing, then the investing public probably would have caught themselves for a moment and looked at that situation and said, well, hold on a minute. I wonder if he's just kind of selling his book. Maybe things aren't as bad as they turned out to be. Lo and behold, everyone knows what happened. Everyone knows the history books, and I don't want to spend these few minutes going over that. But my purpose is to say it's a media problem. So in our law reform world, Wall Street is being manipulated. It's being gamed. People are making billions upon billions of dollars, and it's the investor that's losing. And this was not the purpose of the stock market. So if you like the video, subscribe. If you don't like the video, subscribe. If you have some comments, throw them in the spaces below. Join the conversation, and help us get to the White House. Until next time.